Hello and welcome to our CIMA P3 Performance Strategy Lecture Recap number 20. This one was on interest rate risk. So managing our interest rate risk, first of all, we have two methods. We have internal methods, and this will include things like smoothing, which means that we maintain a balance between our fixed and floating rates. Matching means we match our assets and liabilities and try to have common interest rates on both so that they set each other off. Or we can have netting, which in a case where we aggregate all of our exposures and calculate our net exposure and try to manage that risk. Our other management methods are external to the firm. The first of these will be over the counter. That will be things such as a forward rate agreement with the bank, or interest rate guarantees, again from the bank. These are over the counter, tailored to the exact amount that you want to hedge. Exchange traded, well, that's things like interest rate futures and interest rate options. These are not tailored, they're set contracts, same as our currency futures and options. So let's look at some of the internal ones first. The forward rate agreement. So what is a forward rate agreement? Well, it's a forward contract for an interest rate, same as our currency forward contract. It's for the future, and what I mean by that is that if you know that you are going to have to take a loan out in say 3 to 6 months, you can set the interest rate for that time. Okay, so you know you're going to have to take a loan out in 3 to 6 months, so you can agree a forward contract on the interest rate for that time. It's short term generally, and it's usually for loans or deposits, and it's usually quoted at 3 to 6 months, and it'll be dependent on LIBOR, so LIBOR +1 or +1.5, something like that. How do we actually do it? Well, we agree that forward rate with the bank, we wait until the date of the loan arrives, and the difference will be payable to you. So if the interest rate moves favourably, the difference will be payable by the bank to you, and we did an example of that in class. Remember though that the borrowing is actually done separately. The borrowing is not part of this agreement, it's just an agreement on the amount of interest, and the borrowing is actually done separately. An interest rate guarantee then. An interest rate guarantee is a contract again with the bank. It secures the rate, i.e. it guarantees it, but you don't have to exercise it, so it's an option. You do, however, have to pay a premium like other options, but you can take advantage of low rates whilst also being secured against high rates. Be careful in a question though, because there may be a floor rate below which the bank will not guarantee. On to external methods. Interest rate futures. What are they? Well, they're standardised contract and they're exchange traded, same as currency futures. They're like a forward contract on a notional capital amount, and they may be called STIRs in a question. Why do we actually use them? Well, we use them to hedge borrowings, to protect against a rise in interest rate, and we would sell futures in that situation. So if we're hedging borrowings, trying to protect against a rise in interest rates, we would sell futures. Complications being, well, again, you're stuck with the contract size and the length of contract. You have to pay that margin and deposit, which means that you have to top it up if it moves against you. And speculators dominate the market, so it may move in unexpected ways. How do you actually do it? Well, you decide whether to buy or sell your future. If you're borrowing, you will sell a future. If you're lending, you will buy a future. The profit or loss on the future then will be offsetting the profit or loss on the loan. The price of the future, well, it's quoted as 100 less your interest rate. So for example, if your rate is 5%, the price will be 95%. So what that means is if the price rises, if rates fall, So the price rises if the rate falls. And we did an example of that in class. Remember, however, that on this module you don't need to be able to do the calculations on an interest rate future, but just to understand how it actually works. That takes us on to swaps then. interest rate swaps, we do need to be able to do the calculations on this. So how do we do that? The steps are: number one, identify the type of loan with the largest difference in rates, i.e. fixed or floating, which has the largest difference in rates between the two firms who are thinking about having a swap. Number two, who can borrow this loan the cheapest. So once you identify that, they borrow using that rate and the other party uses the other type of loan. So if party A can borrow the loan cheapest using fixed borrowings, they borrow using a fixed rate and the other party borrows using a floating rate. Then calculate the total interest difference, undertake the swap, and that will be your interest rate swap. The only way to do that really is to look at different examples of it. The problems are there's a credit risk. If the counterparty doesn't pay for, or not the counterparty, but if the other person in the swap doesn't actually pay their borrowings, you may be open to credit risk. So use a counterparty, usually a bank, to see you through that. They're binding, so you can't get out of them, and it may be the wrong decision, but that might be the case with any hedging. Why would you use them? Well, you can switch to a floating rate if that's what you wanted to do. You can usually get a lower interest rate than you could otherwise. You may have certainty because you go to a fixed rate. Speculation, you may be speculating on future interest rates, and they can be tailored to the amount that you actually want to borrow. So that was our lecture on interest rate risk.